Thank you, Andrew. Thank you, Kevin, for having me. So yesterday, one of the ship owners talked about a wall of capex coming up, and today I'm going to talk about a market that could provide a wall of capital, and that is the convertible bond market. So convertible bonds, the convertible market or the equity-linked market, basically consists of two parts of the market, which is the convertible bonds, and you have exchangeable bonds, which are very similar. The only difference is that exchangeable bonds are, well, in an exchangeable bond, the issuer and the underlying stock are two different companies. Can you hear me? Yeah. So, as a good investment banker, I'm obviously going to spend some time on ourselves. So, DNB Market, we have a dedicated team of within convertible bonds. So that's both on the investment banking side and on the sales and trading side. We do represent all the DNB offices in Europe and obviously here in Singapore, and also we do the convertible bonds from New York. We have me and my dear colleague, which is also in the audience today. We've been spending around 17 years in this market. We did actually one of the first convertible bonds we did was for a shipping company, so that was for Golden Ocean back in 2007. And shipping companies they have actually been quite active in this market, although it maybe not appear like this for the last, let's say, 4 or 5 years. But before that, there was actually quite a lot of shipping companies that did issue convertible bonds. You can see some of the names here. So Golden Ocean, as I mentioned, Frontline, Golar, and here in Asia we have Pacific Basin, which we did a convertible bond for a couple of years ago. In addition to that, obviously you have companies such as Eagle Bulk. They've done a convertible bond. Scorpio Tankers, DHT have done a convertible bond. Now it may look like it hasn't been a lot of convertible bond issuance over the last couple of years, but even this year, and in fact, especially here in Asia, it's been a quite an active market. Unfortunately, it has not been within shipping. It has been within technology, and some of the largest convertible bonds ever issued. In fact, the one largest convertible bond ever issued was issued this year from Alibaba. That was a $5 billion convertible bond. And you also had JD.com, which is also an Asian company, Trip.com, based here in Singapore, listed in Hong Kong, and Lenovo, also a technology company. So this year has actually been quite a big year for Asian convertible bonds, with around $30 billion worth of issuance. Where the Alibaba convertible was $5 billion out of those. The US market also quite big this year. It's approaching $50 billion this year. The only disappointment has been the European market, where we've only had around $5 billion worth of issuance this year. So typically Asia and Europe is typically the same size. Not this year, where Asia has about 5 or 6 times more issuance than Europe. So why should shipping companies issue convertible bond? Well, as I mentioned, in addition to a very low coupon and typically dilution at a high premium, there's also today a lot of demand for convertible bonds from investors, which means that the valuation achievable is very high. And as we haven't seen a lot of issuance from the shipping companies, that is probably one of the sectors where investors are particularly keen to get exposure to, because these investors are, they're global investors, they have a global mandate, and they cannot only invest in technology convertible bonds, which has been the biggest group of issuance this year, together with pharmaceutical companies. So that's one reason that shipping companies should look to this market. Convertible bonds are typically unsecured, so there's no security, there's no covenants, and there's bullet payment. Typically, the duration is from 3 to 7 years. Here in Asia, it's quite typical to have a put option. And there's a reason for that. I can come back to that. In addition to that, it's quite a flexible instrument. So in addition to being unsecured, as you know, there's at the end of the life of a convertible bond, there's basically only two outcomes. So either the convertible bond converts to shares, which means that the convertible bond is in the money, or the convertible bond is out of the money, which is basically, it means that it doesn't convert. So within shipping, we've actually seen that most of the convertible bonds that have been issued have not converted. So for instance, as you saw on the first slide, convertible bonds from typically like Frontline, Golden Ocean, Ship Finance, BW Group into BW LPG, none of those convertible bonds were actually converted, so they're basically very cheap financing. Pacific Basin, that was converted, and we had another company here in Asia, Evergreen Marine. They did a $300 million convertible bond. So that was a container shipping company. That was in 2020, and that stock has gone through the roof. So that this was also converted. But only roughly 1/3 of convertible bonds are actually converted. And as I mentioned, if they do convert, it will be at a substantial premium to the current stock price. I mentioned also that the valuation today is actually very good. And the reason for that is that we haven't really seen a lot of issuance. When it comes to execution, so it's also typically fairly fast. But a couple of weeks from the company decides that they want to go to market until we start what's called pre-sounding is typically the norm. And then, obviously, there are some drawbacks to convertible bonds. And there's a lot of misconceptions, which I'll come back to. But I mean, obviously, one of the main disadvantages versus just doing a regular high-yield bond is that there is a potential for dilution. So that's obviously negative. And then the other negative aspect of convertible bonds, comparing it to doing a straight bond or just doing straight bank debt, is that there's some stock, or it can be some stock impact on deal day. In addition, it's obviously it's a more complicated product than just a straight bond. So it gets a little bit, it's a more, you need to get into it and kind of understand valuation, and that can be slightly complicated. And then comparing it to raising equity. Now, obviously, convertible bonds are mainly debt instruments, so you're not going to improve your balance sheet. And in addition, comparing it to equity, although they're unsecured and there are no covenants, if you don't pay the coupon and you don't pay the principal at maturity, well, that's an event of default, which is obviously different from doing equity. Now, not all companies can issue convertible bonds, because in the convertible bond and in the mathematics, there is what's called convertible bond arbitrage, which is kind of the foundation for doing a convertible bond. And that has to do with the optionality and the volatility of the stock, which basically means that to get proper valuation and proper pricing from a convertible bond, you have to have a listed stock. So a private company is not going to get very good valuation in a convertible bond, because there's no volatility in a company that is not listed. So listing is a more or less a prerequisite. In addition to that, there's although there are many very categories of companies that are issuing convertible bonds. Some are investment grade, some are high yield, and some are very weak companies. But if you want to get the best valuation, it has to be at least a relatively good credit, because investors here, they want to know that it's going to be highly likely that the convertible bond will be paid back. Also, in addition to the listing, it has to be some form of stock liquidity. So typically, I would say minimum kind of $3 to $5 million in daily stock liquidity. If it's $10 million per day, that's great. And also then that the stock is at least exhibits some sort of volatility. If it's a very low volatile stock, valuation is going to be kind of impaired because of that. So by high volatility, I mean at least 30% of volatility. And then when it comes to the size, yeah, again, the biggest convertible bond ever issued was $5 billion this year, so that's obviously the kind of a maximum, but anything below $100 million, and then it's, yeah, you're going to lose, you know, you're going to lose some investors because it's just going to be too small and too illiquid. So this is just an example from, it's actually from an offshore company, which we typically do kind of a, you know, we kind of try to show, okay, what are the pros and what are the cons for a particular company when you look at what, you know, what investors want to see from an issuer. So, you know, best case, it's investment grade. It's rated by both S&P and Moody's. They have bonds outstanding. They have, you know, options outstanding. Maybe they have convertible bonds outstanding already. It's a liquid stock. Maybe, you know, at least maybe, you know, $10 million per day. There is stock borrow available, and so forth. So this would be an ideal scenario. So that doesn't mean that all issuers, you know, checks all the boxes, you know. Many companies they're not rated, they don't have any options, you know, there's maybe not enough stock borrow, and then we can, you know, look into that, but this would be kind of an ideal scenario for a typical issuer. And then in a convertible bond, there is various alternatives in terms of, you know, the structuring, the duration, the size. And also there's, of course, a trade-off between the coupon and the premium. So typically, companies that want to have the lowest possible coupon, you know, possibly down to as close to 0% as possible. So a lot of the Asian companies this year, actually, so JD.com, Trip.com, Alibaba, the coupon there was between 0.25 and 0.75, so very low coupon. But then again, they're also relatively good credits. But you know, there's that, as I said, the trade-off between getting the highest possible conversion premium and the lowest possible coupon. And you know, some companies want to have the highest possible premium, while other companies just want to have the coupon, you know, as close to zero as possible. Yeah. And then there's various other structuring things that you can add, like a call option. Here in Asia, a lot of the convertible bonds have a put, so typically a structure will be maybe a 5-year convertible bond with a 3-year put, or a 7-year convertible bond with a 4-year put, would be typical structure here. And then there is the dividend protection. So typically convertible bonds, they have if a company pays dividend, there will be a conversion price adjustment. But you know, some companies rather would have a slightly higher coupon and not adjust the conversion price. And as mentioned, one other important factor is that there has to be some stock borrow available. So that comes down to the two groups of investors. So there is the outright funds, and then there is the hedge funds. And hedge funds, which is between 50 and 60% of the market today, they're going to hedge the stock, their position, so they're going to be long the convertible bond, and they're going to be short some of the underlying stock. And for them to establish that position, they need to have stock borrow available, which is slightly more challenging here in Asia, which is the reason why many Asian convertible bonds have a put option, which makes what's called a bond floor much higher, and the need for stock borrow significantly less. So here are some typical investors. So today, hedge funds are the largest part of this market. They're probably around 60% of the capital, while the outright funds are around 40%. So these are dedicated convertible bond investors. Some of them obviously have other pockets as well, but you know, they invest in convertible bonds. So there's a lot of misconceptions about convertible bonds, and here are some of the main misconceptions. There's a lot of text on this page, but I'll go through them quite quickly. So typically we'll hear that you know, a convertible bond will lead to continuous stock pressure. So you know, it's just going to put some sort of ceiling on the stock. It is true that there's going to be some hedge funds involved, but you know, even a hedge fund. So let's say a hedge fund, you know, if they invest $10 million in a convertible bond, yeah, they will be short maybe $3 or $4 million worth of stock, but even they are going to, all the investors in the market want the stocks to appreciate, and all investors are getting better returns from shares that are appreciating in value. But it is true that hedge funds, they do set up their position on a hedge. But that doesn't mean that that hedge funds want the shares to come down. Quite on the contrary, all investors are getting the best returns when stocks are appreciating. And another kind of misconception is that CB investors will convert if the convertible bond becomes in the money, which is not true. Investors, they will convert at maturity. So even if it's a 5-year convertible bond and the stock goes in the money, which was actually the case for Evergreen Marine in 2020, that stock was very quickly in the money, and over the next number of years, the stock appreciated. So the CB was very deep in the money. So the stock, it 5 or 6 times doubled. But even then, investors did not convert because there's always optionality. There's always another coupon to have. So investors, they will wait until the very last couple of weeks before final maturity, at the end of the conversion period, before they will convert. And then the final one I thought I'd just mention is that it's not the conversion price does not put a cap on where the stock price will go. I mentioned Evergreen, and another example here in Asia is Pacific Basin, which also did a convertible bond. Obviously, that's a dry bulk company, did it in 2019, and even there, quite quickly, the stock appreciated, and it went through the conversion price, and it continued above that. So that's also another misconception. Very good. That was my slides. I'm getting signal here that my time is over. But anyway, the market for convertible bonds, I would say, especially within the shipping company, is wide open, and it's definitely an attractive market with very good valuations. Thank you.